Hello, everyone, and welcome to Deloitte's Debriefs tax webcast series in Asia Pacific. Our webcast today is from our corporate income tax series and is titled Hong Kong Change of Offshore Regime for Passive Income, or short FSIE, which stands for Foreign Sourced Income Exemption. My name is Klaus Schürmann, and I'm a tax partner based in Deloitte, China, here in Hong Kong. I have the pleasure of hosting today's webcast. I have three speakers with me today, which are Shanice Yu, Yu Hong Chung, and Miranda Chan. Shanice is a tax partner, Hong is a tax director, and Miranda is a tax senior manager. They're all based in Deloitte, China, with me here in the Hong Kong office. You may access our bios on the left side of the screen. Before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, please submit at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentations. Otherwise, we'll come back to you afterwards. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey on the screen. Thirdly, if you require attendance record for this event, you will receive an automated email with CPE certificate after watching for at least 15 minutes. Now with that, let's go to the agenda. So I'll quickly run you through the agenda. We'll start with a short background recap, where the rules are coming from and why Hong Kong puts all the effort in. Then we'll shortly talk about the economic substance requirements, participation exemption, the nexus requirement, which is particularly relevant for the intellectual property income, double taxation relief, then more on the admin side, taxpayers' obligations, and then the ruling mechanism, a very interesting point with regard to the economic substance qualifications. And at the end, a short summary and Q&A. Let's move forward. And firstly, let us get you all active with a polling. The first question here would be, do you have a Hong Kong entity in your global investment structure? And if so, what is the main purpose for the Hong Kong structure or the Hong Kong entity? So please press your votes. And in the meanwhile, Shanice, let's get interactive on our side as well. What reaction do we actually expect in the market with regard to these rules?
Thank you, Klaus. Obviously, with the FSIE regime, there will be a change to the Hong Kong tax landscape. It is well understood by many multinational companies that it is necessary to have Hong Kong to be in line with the international tax standard. Well, as we know, many multinational companies have been setting up Hong Kong entities for different purposes, say as the investment holding platform or treasury hub. So a lot of the companies do hope that the Hong Kong government will be able to formulate the measures to minimize the impact to the taxpayers. And the market participants do hope that the Hong Kong government can give a relatively clear guidance on FSIE so that the companies are able to comply with the requirements and continue to enjoy the tax exemption. Actually, the Hong Kong government has been reacted to many common issues during their consultation process. And their proposed solutions are welcomed by the market, such as the acceptance of the sharing of resources within the group, the lower bar for the pure equity holding company, a more friendly participation exemption requirement, and the look-through approach for the foreign tax credit, etc. In addition, the Hong Kong Tax Bureau also allows the taxpayer to get a higher degree of certainty through the commissioner's opinion or advance ruling application. And all these mitigation measures would minimize the impact to the taxpayers and welcomed by the market participants. So, Klaus, this is the general expectations and reactions from the markets under our observation.
Thank you so much, Shanice. And yeah, we have the polling results in here, and very interesting indeed. So I think the leading box is investment holding, but it's actually closely followed by trading, including procurement and distribution. So I guess the good news for this group, or for this large group of participants here, is that we're not talking too much about trading income, and we'll probably focus on some other areas. But before I jump ahead, let's maybe move on, and I'll do a little recap. So where does this all come from? So the starting point of these rules is, as everybody may be aware, it's not that Hong Kong tries to generate additional income, but it's the European Commission that, under its fair taxation directives, did a peer review of Hong Kong's territorial tax regime, and not only Hong Kong but also other countries were in that review, which took place about a year ago. And the result was that certain passive income is considered as not in line with the requirements, and therefore Hong Kong, with regard to this income, was put on a watch list. And following that, Hong Kong confirmed to the EU that it would change its regulations by the end of 2022 in order to not be moved to the blacklist, which would happen with effect from 1st of January 2023. So I think Hong Kong is well on track to meet the requirements. And with that, let me give you an overview of what passive income actually is on the next slide. So the definition of passive income in this regard would include interest, dividends, disposal gains on equity interest, and the income from the use of intellectual property, so mainly royalties. Now, if we move clockwise here from the economic substance requirement box, there are ways to, let's say, still keep this type of income tax exempt, but just that the requirements are becoming a little bit more defined. The first one would be the economic substance requirement, which is applicable to interest, dividends, and disposal gains. And I'm just giving you a very brief overview here before my colleagues will actually dive into the details of all this. So please bear with me for a moment. Now, while the economic substance requirement may be a little bit more, let's say, difficult to meet the requirements, there's also the participation exemption, which is applicable to dividend income and disposal gains. And the participation exemption is actually formed a little bit along the lines of what is typical in the European Union. If both exemptions cannot be applied, we still have as a fallback the double taxation relief. And as another entry or exit door rather, we have the remittance principle, the received in Hong Kong box shown here, and that only income that is actually received in Hong Kong would be caught under the rules. So this is a very brief summary, and with that, let's move to the second polling question before we actually get into the details of the rules. So again, question to everybody: which type of offshore passive income, so these types of incomes that I just mentioned, which types of these income are most relevant to you or your organization? So please click now. And as we wait for the results, Hong, let's get you active as well and involved. What can companies actually do at this moment as a reaction to these changes of the rules?
Thanks, Klaus. I guess at least companies can do two things currently. First of all, because the FSIE regime would be effective 1st of January next year, so it will only apply to income that are accrual and received after that date. So if company plans to, for example, declares a dividend, they may want to do so on or before the effective date of the FSIE regime, such that the dividend received by the company, even after the 1st of January 2023, will not be caught under this regime. That's the first point. And the second point is Actually, the ILD allows taxpayer to apply for commissioner's opinions in order to obtain more certainty of the tax treatment of different foreign source income, even before the effective date of this rule. So if you're uncertain that whether you could meet certain exemption requirement under the FSIE regime, in particular, whether you have sufficient substance, you may consider applying for a commissioner's opinion. And the timing is, of course, on or before effective date of this rule, which means before the 31st December 2022.
Yeah, thank you, Hung. I think we will come back to that topic a little later, right, in our discussion. So we have the results in, and not very surprisingly, 51% consider dividend income the most critical type of income with regard to the rules, and then followed with quite a distance by interest income. So I think this is in line with expectations. Okay, I think everybody is well attending and active and ready to jump into the details. Now, Shanice, may I ask you to give us a little bit more background?
Thank you. I think many companies may have questions on the scoping of the new FSIE regime. So let's look at the definition of the covering scope. The first question would be, who would be the covered taxpayer? Actually, an entity that is part of an M&E group and carries on a business in Hong Kong will be in scope, irrespective of the quantum of the M&E group's revenue or assets. And to be more specific, an in-scope M&E group, while making reference to the group definition, is a group that includes at least one entity or permanent establishment that is not located in the jurisdiction of the ultimate parent entity. And so it is effectively defined as any group that has a taxable presence in Hong Kong and one another location. And under the current draft legislation, originally there are excluded entities from the scope of FSIE, such as the investment fund or real estate investment vehicle or insurance investment entity, etc. However, based on the latest discussion between the Hong Kong government and the EU, there will be a change. To avoid the abusive use of this exclusion, the excluded entities clause will be removed. Then next, what are the covered entity? We can go to the next page. There are actually, as what mentioned by Klaus in the beginning, there are 4 types of foreign sourced income. Whenever they are received in Hong Kong, will be the in-scope covered income. These are the offshore dividend, interest, disposal gain, and the intellectual property income. For disposal gain, it is defined as any gain, profits derived from the sales of the equity interest in an entity. And it is specifically actually stated in the draft legislation that the partnership interest is not counted. And for the IP income, it refers to the income derived from the use of the intellectual property, which is a bit different from the OECD definition, where sometimes the IP income also covers both the use and sales of the IP. And certain income will continue to be excluded from the scope. It is the interest, dividend, and disposal gain derived by the regulated financial entity from its carrying on of the core business, such as the banking, insurance, SFC regulated business. And from the latest news, the excluded income would also cover the non-IP offshore passive income from our current preferential tax regime in Hong Kong, say the offshore interest, dividend, or disposal gain derived from or incidental to the carrying out of the profit-producing activities as required under our existing preferential tax regime in Hong Kong. Then the next will be how do we define the income received in Hong Kong? We can go to the next page. The scope would generally refer to the specified foreign source passive income received in Hong Kong. And under the draft legislation, which is prepared partially with reference to the FSIE regime in Singapore, whether the subject income is regarded as received in Hong Kong would highly depend on the location of the fund flow and the usage of the subject income. So the term of received in Hong Kong refers to the remitted to or is transmitted or brought into Hong Kong or used to satisfy any debt incurred in respect of a business carried on in Hong Kong or used to buy movable property, and the property is bought into Hong Kong. Then go to the next page. There are two examples from the Tax Bureau on whether the specified foreign sourced income is received in Hong Kong. In this example, the Hong Kong company is an M&E entity carrying on a business in Hong Kong. It has a wholly owned overseas subsidiary, and its overseas subsidiary declared dividend to the Hong Kong company. Under Situation 1, the Hong Kong company maintained a bank account overseas to receive the dividend. The funds in the bank account were not remitted to Hong Kong. They were wholly used to acquire an immovable property overseas. As the dividend were never remitted back to Hong Kong, they would not be regarded as received in Hong Kong. And so this Hong Kong company can continue to be tax exempt under the FSIE regime. While under Situation 2, the Hong Kong company received the dividend through a bank account in Hong Kong. And so the dividend was regarded as received in Hong Kong. The new FSIE regime would apply. Then go to the next page. In short, when the specified foreign source income is received in Hong Kong, the FSIE regime applies. However, when certain conditions are fulfilled, the subject income will continue to be tax exempt in Hong Kong. And when will be the taxable year? And when will those exemption requirements to be satisfied? The taxable year refers to the year of receipt of the subject income in Hong Kong, and the exemption requirements refer to the conditions of the year of accrual. Say it is the same example. Dividend declared in the year of assessment 2023-24 and received in the year of assessment 2025-26. Those exemption requirements, such as the economic substance requirements, participation exemption conditions, will have to be satisfied in the year of accrual. This is in the year of assessment 2023-24. If not, if all these conditions cannot be fulfilled, the subject income will fall under the FSIE regime and taxable in the year of assessment 2023-26 when it is received in Hong Kong. This is the general scope of the FSIE regime. I pass it back to Klaus.
Yeah, thank you, Shanice. So you mentioned some forms of exemption, and one is the economic substance requirement. Hong, can I ask you to expand on that a little bit?
Yeah, sure. Thanks, Klaus. As mentioned earlier, economic substance requirement is a very important concept within the FSIE regime, because if the passive income, in-scope passive income are received in Hong Kong, then they may still be considered not taxable in Hong Kong going forward, even under the FSIE regime, provided certain conditions could be met. And one of those is the economic substance requirement. It applies to non-IP income, such as interest, dividend, and disposal gains. And it actually requires a taxpayer to carry out the specified economic activities in Hong Kong, meaning the making necessary strategic decisions, as well as managing and bearing the principal risks in respect of the asset that the entity acquires, holds, or disposes of. The ILD also introduced an adequacy test in relation to the specified economic activities, which requires the taxpayer to have adequate number of qualified employees in Hong Kong, as well as adequate operating expenditure in Hong Kong to carry out with respect to the specified economic activities. The IRD indicates that the relevant activities for interest income from loan can be carried out through the holding of board meetings and strategic planning by finance department, etc. And with respect to certificates of residence status, even if the Hong Kong company can obtain a COR before, it could not be used to show that it has sufficient substance under the FSIE regime, because the IRD considers that the substance under the COR as well as economic substance under the FSIE regime should be considered in separate contexts. Lastly, regarding outsourcing, although the substance of the group cannot be considered as a whole, the IRD allow outsourcing of the taxpayer, meaning that even if the taxpayer does not have sufficient substance to perform the specified economic activities, it could actually outsource such activities to another party to conduct such activities. But the condition is that there should be adequate monitoring by the taxpayer, and that the outsourced activity should be conducted in Hong Kong. Moving on to the next slide. For pure equity holding company, actually a reduced economic substance requirement would apply. The definition for pure equity holding company is that it can only hold equity interest in other entities, and it can only earn dividends, disposal gains, and income incidental to the acquisition, holding, or sale of such equity interest in Hong Kong. Actually, the receipt of the incidental interest income, for example, interest on the deposit of the dividend received, should not affect a taxpayer's status as a pure equity holding company. And if the taxpayer could meet the definition of a pure equity holding company, as mentioned earlier, then a reduced economic substance requirement would apply. And it requires the taxpayer to comply with the registration and filing requirement with the relevant ordinance. For example, company ordinance, business registration ordinance, limited partnerships ordinance, etc. And the second thing is that the specified economic activities would become the holding and managing its equity participation in Hong Kong. And the last requirement would be that the taxpayer should have sufficient human resources and premises to carry out the specified economic activities. We can go to the next slide for some examples. The IRD provides a few examples on whether the pure equity holding company could meet the economic substance requirement. On top of this slides, we have a pure equity holding company in Hong Kong, and it also maintains a bank account in Hong Kong. But because it does not have sufficient substance, and so that's why it engaged a service provider to handle the registration and filing matters on behalf of itself in Hong Kong. In the first scenario, the Hong Kong company actually has a share office in Hong Kong. It also has 2 resident Hong Kong directors who are responsible for holding and managing the equity investment. In this scenario, the IRD consider the economic substance requirement is met because, first of all, it has someone to take care of the registration and filing matters in Hong Kong. It also has adequate human resources and premises. And that the most important thing is that it has 2 resident directors to hold and manage the equity investment in Hong Kong. So it would meet the specified economic activities in Hong Kong. And that's why the IRD consider the overall the economic substance requirement could be met. But on the other hand, in the second scenario, the Hong Kong company only has 1 nominee director in Hong Kong. But in this case, the holding and managing of the equity investment would be performed by the shareholder and director outside of Hong Kong. And because such activities are performed outside of Hong Kong, the IRD considered that the specified economic activities requirements could not be met, and therefore the economic substance requirement could not be met in this case. Moving on to the next slide. the IRD also provide examples on outsourcing. On the left-hand side of the slides, you can see there are two Hong Kong companies. Hong Kong One, which is a holding company, also engaged in other business. It holds Hong Kong Two, its subsidiary. The principal activities for Hong Kong One includes the holding of shares and equitable interests in other company, and it derives dividend income and disposal gains. It provides funding to its subsidiaries and fellow subsidiaries both inside and outside of Hong Kong. And because it does not have substance such as a resident director, it outsources certain activities to Hong Kong 2. Hong Kong 2 is the service provider which provides management services to its group companies. It also makes strategic decisions in relation to Company One's Hong Kong One's equity investment and financing arrangement with respect to its subsidiaries and overseas fellow subsidiaries. Hong Kong 2 has one director as well as 3 employees who are all based in Hong Kong to perform the relevant services. In this scenario, the IRD considered that the economic substance requirement is met by outsourcing, but this is based on the assumption that under the outsourcing arrangement, including the activities performed by Hong Kong 2 on behalf of Hong Kong 1, should be properly documented, and that the outsourced activity should be adequately monitored. Next slide, please. Regarding the adequacy test introduced by the Hong Kong Tax Authority, there is actually no specific threshold for the number of employees as well as the amount of expenditure, either in the proposed legislation or in the guidelines published in the IRD's website. These actually may appear to be a subjective judgment of the IRD, and the IRD will consider the following factors when exercising their judgment. First of all, the average number of employees with having regard to the nature of the specified economic activities. For example, whether it is a capital or whether it is a labor-intensive industry. And the second condition is whether the employees are employed on a full-time or on a part-time basis. The next condition is whether the qualification of the employees are related to the nature of the specified economic activities. And the quantitative as well as the qualitative aspect of the management and the administration of the taxpayer would also be important. And lastly, whether the office premises have been used for undertaking the specified economic activities and whether the premises are adequate for such purposes. All these factors would be considered by the IRD on whether the specified economic activities performed are commensurate with the income earned by the taxpayer. Next slide, please. Regarding outsourcing, there are actually a few points to note. First of all, regarding the adequate monitoring of the outsourced activities. In the draft legislation, there is no requirement that the monitoring should be conducted in Hong Kong, meaning that the monitoring activity could be performed in Hong Kong or outside of Hong Kong. However, the underlying economic activity should be performed in Hong Kong. And that if it is outsourced to a service provider, that this outsourced service provider should ensure that it has sufficient capacity to perform the services in Hong Kong as well. And then the second factor would be the documentation of the monitoring mechanism. The IRD expects the monitoring mechanism to be documented either as part of the outsourcing arrangement or in an internal policy document of the M&E group. The third factor regarding the adequacy test, the IRD will take into account the resources of the outsourced service provider in Hong Kong. The number of qualified employees and the amount of operating expenditure of the outsourced service provider should be commensurate with the level of the income being earned, as mentioned earlier. And also the resources of an outsourced service provider would need to be sufficient in order to cater to the combined requirement of each entity that it provides services to. In other words, there will be no double counting of the substance. Lastly, regarding service fee, the ILD generally expects the outsourced service provider to charge the M&E entity which receives the services a service fee for the economic activities performed in accordance with the transfer pricing rules. This could actually give rise to additional tax costs because if the paying M&E entity cannot claim a deduction for the expenses incurred in the production of the exempt income, while on the other hand, the group entity which provides the services is taxable in respect of the service income that it received. Moving on to the next slide. When the Hong Kong government first introduced the FSIE regime, there are actually concerns on whether the economic substance requirement would contradict to the source of profit. And actually, the government has emphasized that the two concepts should be considered separately, and they are actually under separate context. And you can see on the left-hand side of this slide, there is a Hong Kong company which provide loans to its non-resident associates and derive interest income from such loan. The Hong Kong company actually is a non-pure equity holding company, and it engaged in investment business as well as money lending and intragroup financing business. And it also carries out shipping business. The activities in relation to the loan, for example, negotiation and conclusion of the loan, as well as the funding of the loan, are provided outside of Hong Kong. The strategic decision activities in relation to the loan are performed outside of Hong Kong. In addition to that, the Hong Kong company has a physical office in Hong Kong, and it also has significant staff establishment and significant amounts of operating expenditure in Hong Kong. Based on these facts, the ILD actually considered that the source of income could be considered outside of Hong Kong, so that the interest income is offshore sourced. On the other hand, even under the FSIE regime, the ILD considered that the specified economic activities are performed in Hong Kong and also sufficient, such that the economic substance requirement is met. This example actually shows that the economic substance requirement and the source of profit could both conditions could be met at the same time. But just want to raise upon that in case the taxpayer perform more and more activities in Hong Kong, for example, there would be more intragroup lending and borrowing transaction to an extent that the ILD consider the source of income should be determined by reference to the operation test rather than the provisional credit test. Then we need to pay extra attention in order to structure the activities in Hong Kong in order not to taint the offshore claim of the taxpayer in Hong Kong. I think that's a brief introduction about the economic substance requirement. Back to you, Klaus.
Thank you, Hong. And that is quite exhaustive, I would say. And I see the questions raining in on us already. So I think we'll have a lot of Q&A or rather follow-up to do. But lucky enough, there's an easier way to get the income exempt. And I would hand it over to Miranda to give us something on the participation exemption, please.
Sure, thanks, Klaus. So from what we heard just now, it seems that the economic substance test is quite subjective. Many of you may be asking, oh, what is meant by adequate? Is there any number, etc., etc.? Seems that there is no quick yes or no answer on economic substance. But no worry, there is another exemption under FSIE. Even if economic substance is not fulfilled, the income may still be exempt. This is participation exemption. However, this participation exemption applies to dividend and disposal gain only, This means it cannot protect other in-scope income, for example, interest income. To satisfy participation exemption, there are 3 conditions. We will look at them by a simple example here. Now, we assume company A is a holding company, and then it holds company B, an overseas investee company, and company A will receive dividend from company B. For participation exemption to apply to the dividend received by company A, first, company A, which is the holding company, has to be a Hong Kong resident person, or otherwise, company A has to have a permanent establishment in Hong Kong. In relation to a company, Hong Kong resident means a Hong Kong incorporated company or a foreign company with normal management or control in Hong Kong. Second, company A has at least 5% of equity interest in company B. Third, company A has continuously held the equity interest in company B for at least 12 months, immediately before the income accrues. Now, for those who keep close track of the FSIE development in Hong Kong may wonder, well, I thought there should be a passive income tax under participation exemption. Well, originally there was. Previously, in the consultation stage, there was a condition requiring the investee company not to have more than 50% of passive income. But it is now removed in the draft legislation and replaced with the 12-month holding period test we talked about just now. This is indeed a good news, as the holding period test is generally more helpful for multi-layer holding structures. Next slide, please. The participation exemption is subject to specific anti-abuse rules. First is the switchover rule or the subject to tax condition. It requires that disposal gains and dividend income, or the underlying profits from which dividends are paid, must be subject to tax in a foreign jurisdiction at an applicable rate of at least 15%. If not, we have to switch over from exemption to tax credit. In considering the subject to tax condition, for dividends, we can adopt a look-through approach, whereby the tax rates and underlying profits of the downstream investee companies will also be considered, up to a certain number of layers. But of course, the underlying profits from which dividends are paid must be at least as much as the dividend. We will illustrate this in more detail by some examples in the next slide, but now we look at the second rule, which is the main purpose rule. There will be no exemption if the main purpose or one of the main purposes of the arrangement is to obtain a tax advantage that defeats the purpose of the exemption. Third is the anti-hybrid mismatch rule. For dividend, the exemption will not apply to the extent that the dividend payment is deductible for the investee company. Next slide, please. Now, the examples here are to illustrate the subject to tax condition. The first one is more straightforward. A Hong Kong company receives dividend from its wholly owned PLC subsidiary. Even though the underlying profits of the PLC company are subject to a preferential tax rate of 15%, which is lower than the standard PLC tax rate of 25%, as the applicable tax rate is at least 15%, the subject to tax condition can be satisfied. In the second example in the middle, Hong Kong company fully owns a BVI company, which fully owns another operating company. We assume the operating company distributes $100 dividend to the BVI company. Then the BVI company further dividends up that $100 to Hong Kong company. Now, with the look-through approach, that is, we do not only look at the immediate dividend distributing company, the BVI company, but also the investee company further downstream. As such, even though the dividend is not subject to tax in BVI and the applicable tax rate in BVI is 0, if the downstream operating company is subject to tax rates of 15% or more, the subject to tax condition can be satisfied. In the third example, The dividends are from a Macau company, then to company X, then to Hong Kong company. We assume the only income of company X is the dividend from the Macau company. For company X, we assume although the headline tax rate is 17%, it does not tax dividend. So the applicable tax rate at the level of company X is 0. On the other hand, the Macau company is subject to tax at a rate of 12% in Macau. If so, since the underlying profits are subject to tax at a rate lower than 15%, the subject to tax condition is not satisfied, and in such case, no participation exemption, and we have to switch over to tax credit. So if we have to wrap up for participation exemption here, I think the key points to take away are: first, there is a look-through approach for dividend. Second, there is a subject to tax condition, which looks for an applicable tax rate of at least 15%. The applicable tax rate refers to the highest corporate tax rate of the foreign jurisdiction, which applies to the relevant income or profits. So this may not necessarily be the headline tax rate. This means we have to be careful of whether the underlying profits are subject to any tax concession or preferential regime in the investee jurisdictions. Now, so far, we have talked about interest, dividend, and disposal gain already. Klaus, how about other in-scope income, for example, in IP income? How FSIE may impact IP income?
Indeed. I think it's appropriate that we spend a lot of time on dividend income, right, based on the poll results. But I think, Shanice, it's still time to change gears a little bit and look into IP income.
Right. Actually, the exemption requirements for IP income are different to those what we have just mentioned for the interest, dividend, or disposal gains. Instead of talking about the economic substance requirement or the participation exemption, particularly for the offshore intellectual property income, we will adopt the nexus approach, which is a kind of the approach adopted by the OECD in determining the extent of income to be tax exempt. While we will have to keep it in mind that when we are talking about the IP income, which can be qualified for the exemption, this only refers to the income from the use of patents or the copyrighted software, which shall normally be supported by the R&D. And the income from the marketing-related IP assets, say the trademark or brand name, etc., will not qualify for this exemption. In short, the relevant IP income will be exempt based on a fraction by dividing the qualifying expenditures on R&D to develop the IP over the total R&D expenditure on this intellectual property. So, we can see from this formula, the more qualifying R&D expenditure, the higher the ratio, and the more IP income can be tax exempt. It is also clarified that in computing this ratio, the R&D expenditure exclude the interest payments and the payments for land and building. And the qualifying expenditure refer to the R&D expenditure directly connected to the IP, but exclude the IP acquisition cost, while it is at the same time provided with a 30% uplift in this formula. And the good news here is that the definition of the R&D activities has been updated and extended to cover also the R&D activities conducted by the taxpayer outside of Hong Kong. So previously, particularly in this aspect, under the taxpayer angle, it only covers the activities in Hong Kong. After the update, this can allow more room for the taxpayer to consider the offshore strategy for the R&D activities and IP income. And under the FSIE exemption, the qualifying R&D expenditure now spent on the R&D activities that are undertaken by the taxpayer or outsourced to unrelated party, either in or outside China, outside Hong Kong, or R&D activities outsourced to resident-related party in Hong Kong are counted in the nexus ratio. I think this is a key summary of the nexus requirement for the IP income.
Thank you, Shanice. So we've discussed a lot about the exemptions that are still and under slightly different or more complex rules possible to be exempted. However, there may be situations, and there will be situations, where the exemption requirements are not met. So in that case, we still have the option to reduce double tax impact by the way of double taxation relief. And Hong, maybe you can give us an overview of these rules.
Yeah, sure. Thanks, Klaus. And indeed, if the income fall under the FSIE regime and cannot be exempt from Hong Kong tax, either through economic substance requirement, participation exemption, and the nexus approach, such income will be taxed in Hong Kong. And to the extent such income have already been subject to tax in a foreign jurisdiction, there will be double taxation issue. And in response to that, the Hong Kong government is prepared to offer a tax credit in such a scenario. For jurisdiction which does not have a comprehensive double taxation agreement or arrangement with Hong Kong, the IRD would be prepared to offer a unilateral tax credit. And for those jurisdictions which has DTA with Hong Kong, the tax credit will be offered based on the DTA specified between Hong Kong and that jurisdiction. One point to note is that the tax credit will be available to Hong Kong residents only. For non-Hong Kong resident person, the foreign tax paid will not be available for a foreign tax credit claim. But even in this case, the foreign tax paid could be treated as a deduction in accordance with the relevant provision of the Inland Revenue Ordinance. Moving on to the next slide. In determining the tax credit available, in particular for dividend, both the foreign tax paid on the dividend, for example, the dividend withholding tax, as well as the underlying profits from which the dividend is paid out of, will be taken into account. Actually, we will adopt a look-through approach for up to a 5-tier of ownership. But in order to apply the look-through approach, one condition is that we need to have at least 10% equity interest, directly or indirectly, in the investee company which suffering the tax. To align the treatment of the foreign tax paid on a DTA jurisdiction and a non-DTA jurisdiction, a consistent approach in providing the tax credit for tax on underlying profit and the look-through approach will be adopted. Using the example on the right-hand side of the slide, for example, if a Hong Kong company receives a dividend from the BVI company, and in fact, the dividend from that BVI company are actually coming from the Chinese company at the bottom, when considering how much foreign tax credit will be available for that dividend income received by the Hong Kong entity, we will consider both the dividend withholding tax from the PLC company to the BVI company, as well as the underlying enterprise income tax paid in China in order to calculate the FTC in Hong Kong. Passing the time back to you, Klaus.
Thanks, Hong. Okay, now let's move away from the income side and more onto the compliance side. And Miranda would give us an overview over some taxpayers' obligations, please.
Sure, thanks, Klaus. So what a taxpayer has to do because of FSIE? We start with the box on top left. In the year of accrual, the taxpayer has to report the specified foreign source income, regardless of whether the income is received or chargeable to tax. Then the taxpayer has to provide information relevant to economic substance, participation exemption, and nexus requirement, etc. This means even though you believe that the income, when it is received, will be exempt, say because of economic substance is fulfilled, you still have to report to the tax authority when the income is accrued. Move to the box below. So when the income is actually received, the taxpayer has to report the receipt of the covered income only if exemption under FSIE is not available. So if an income is subsequently received and you are confident that it is exempt under FSIE, you don't have to report. This saves a lot of trouble for the taxpayer because previously there were concerns that, well, if there is any reporting at the time of receipt for every offshore income, regardless of whether it is taxable or not, it is painful to put in place a tracking mechanism to keep track of each and every receipt and the flow of funds, etc. So move to the right-hand side, the box at the top. If any covered income is received and taxable, and if the taxpayer does not already file a tax return, it will have to inform the Hong Kong Tax Authority within 4 months of the end of the basis period of the year of receipt. Now, the box below is about retaining records for transactions. Generally, for at least 7 years after the transactions or the income is received in Hong Kong, whichever is later. For IP income, additional records, for example, details of qualifying and non-qualifying expenditure, details of IP asset, etc., should be maintained. Also, generally for 7 years after completion of transactions or after exemption claim, whichever is later. Now, so far, it seems that FSIE means quite a lot to taxpayer. Klaus, is there any way to obtain early confirmation on the economic substance and any chance that a taxpayer can reduce their compliance burden under FSIE?
Yeah, we've talked a lot about that, right? I think Hung alluded to that a bit earlier on the commissioner opinion. Please explain a little bit more what the options are at this stage.
Sure. Thanks, Klaus and Miranda. Actually, the IRD acknowledged that with the introduction of the economic substance requirement, it actually creates certain uncertainty to a taxpayer. If we move to the next slide, after the effective date of the FSIE regime, the government actually offer an advance ruling to the taxpayer, which is legally binding to the IRD. And even before the effective date of this rule, the IRD also allows taxpayer to apply for a commissioner's opinion. Although it is not legally binding to the IRD, but the IRD has indicated that it would honor the opinion that is given in the commissioner's opinion. Moving on to the next slide, regarding some guidelines for applying for commissioner's opinion. First of all, any MNE entity which carry on the business in Hong Kong and received specified foreign source income could apply for a commissioner's opinion. But for each applicant, they would need to fill in an application form, and that application form would include information regarding the specified economic activities performed, outsourcing arrangement, if there's any, the number of qualified employee, their qualification, the amount of operating expenditure incurred in relation to the specified economic activities, etc. For a commissioner's opinion, it would be valid for 5 years, commencing either from the year of assessment 2022-2023 or 2023-2024, if there is no substantial change in the arrangement. The IRD has indicated that it would approximately take them 1 month's time to process the application under normal circumstances. From the taxpayer's perspective, if the specified economic activities are outsourced to one of the service company within the group under a single service agreement, the taxpayer may consider apply a commissioner's opinion under group application. And in that case, you only need to fill in one application form only. In other cases, each of the Hong Kong entity may need to fill in one application form. But still, the MNU group may designate one entity to submit the application form on behalf of the whole group in a bundle under one single cover letter. Moving on, the benefits of applying for a commissioner's opinion is that, as depicted in the next slide, first of all, it is certainty, because once we obtain a commissioner's opinion, it will be valid for 5 years, so that the taxpayer can have a 5-year of certainty. The second thing is that it can substantially reduce the tax compliance burden of the taxpayer, because in the tax return, the IRD very likely will introduce a supplementary form for the FSIE regime, which requires taxpayer to provide certain information with respect to the income they receive and substance, things like that. But if the taxpayer has obtained a commissioner's opinion, the level and quantum of information that it needs to provide will be greatly reduced. Moving on to the next slide. If you are having companies in Hong Kong having certain substance but not that much, and you are not very certain and confident that the substance should be sufficient, you may consider applying for a ruling. And also, if your company has intra-group outsourcing activities, you may consider applying for a ruling as well, because once you obtain a ruling, those company within Hong Kong could provide much less information to the IRD when completing the Hong Kong tax return. So this is also a way to reduce the compliance burden. The last thing is, if you have companies in Hong Kong deriving offshore interest income, then I think it is a good a reason for you to apply for a ruling, because for interest income, the only exemption under the FSIE regime would be the economic substance requirement. So applying for a ruling would definitely increase the certainty for a taxpayer. I think that's all about the ruling mechanism. I'll pass the time back to you, Klaus.
Thank you, Hong. So this brings us to the summary, and let's move to the next slide. So we have made this little decision tree to summarize the different pathways of how you can test how to get an exemption or a foreign tax credit with regard to the specific income that is relevant to you. So I would suggest download the slides as mentioned. You can get them from this system and run through the checklist, and this should help to arrive at least at some preliminary result. On the next slide, we have one more thing, as they say. Now, this is some considerations beyond the FSIE that in the current world should be considered. So one thing is the considerations under CFC legislations. So a lot of countries, of course, have these controlled foreign corporations rules, which may have different definitions and different approach with regard to types of income and whether they pick it up. So if under the FSIE your type of income changes or your taxation of income changes, then this might have an impact on your CFC computation in a entity further up the chain. The second one is, of course, the interaction with the global minimum tax and the DMT. So that will come probably in 2024. So again, that will have an interaction, and all requires administration and management of data within your companies. And the third point is the preferential regimes with regard to intellectual property, where again there may be interaction with the treatment from a Hong Kong perspective of the FSIE. So certainly complexities are increasing, and it's really a matter of managing the data, the rules, and the interaction of the rules within the tax department of your companies. So this brings us actually to the end of our discussion today. Firstly, I would like to thank Shanice, Miranda, and Hong for this quite interactive and I think very interesting session, considering the numbers of questions we have received. There are a lot of questions. Let me at least pick maybe one here. We will follow up also with all the questions that were raised afterwards. But maybe Shanice, one question for you at least, as it was raised early on. How would an interest-free loan be treated for a pure equity holding company?
Oh, right. It is a common question from a lot of the companies as well. Actually, a pure equity holding company, as we have previously explained, it will be subject to a reduced economic substance requirement. So you can imagine we have a strict definition on it. It only refers to a company which holds equity interest only and only earns the dividend and disposal gain. So if a Hong Kong company, apart from holding equity interest, it also have interest-free loan or non-interest bearing loan, etc., lent to other entities, even though the loan is not interest-bearing, it will tend its pure equity holding status. And so the reduced economic substance requirement for the pure equity holding company do not apply. This company will be subject to the standard adequacy tax for the non-pure equity holding company from the economic substance angle.
Thank you, Shanice. Thank you. Okay, I think that's really all we can offer here today. I think I would like you to ask you to fill out the short survey that should be coming up any moment on the screen, and give us some feedback. If you joined us late, then we have the presentation archived for future viewing. And if you feel that others, colleagues, etc., would benefit from this webcast, please share the webcast via the share this icon, or have them visit the debriefs website. We will respond to the questions later on. Give us a little bit of time. We'll sort them and get back to you. And also, if you think of any other questions or comments later, just reach out to us, to me, the speakers. We will happily come back to you and have a discussion on the topics. And please, don't forget to tune in to our next scheduled webcast from the Corporate Income Tax Group on the 8th of December with the title Post-Merger Integration from a Tax Perspective. So at last, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. Thanks very much. Have a good remaining day wherever you are. Goodbye.